Okay, imagine this. A huge financial company, they report a net loss, right? $4.3 billion in one quarter.
Oof, yeah, that sounds pretty bad on the surface.
Exactly. But then, almost in the same breath, they say, oh, but our adjusted net income was $5.48 per share.
Right. So you're immediately thinking, what's going on there?
Yeah,
How can both those things be true?
precisely. And well, that's really our mission today. Welcome, everyone. We're doing a deep dive into Capital One's second quarter 2025 earnings.
Because those headline numbers, as you said, they're just massively shaped by the big event,
Yeah,
the acquisition of Discover.
yeah. So our goal here is to unpack this whole complex financial story. We want to look past that initial shock of the quote-unquote loss and really reveal the strategic thinking behind it, the sheer scale of this new combined company and what their long-term vision actually is.
And we'll try to cut through the jargon, give you the insights that really matter.
And just so you know where we're getting this, our deep dive, it's built right from the source.
Yeah, we've gone through the Capital One second quarter 2025 earnings call transcript and their press release.
So this gives us a direct window into what the leadership team was telling investors about this, well, monumental quarter.
Okay, so where do we start? I guess with the acquisition itself.
Absolutely. I mean, that's the dominant narrative here. The Discover deal closed on May 18th.
Right.
And Capital One's CEO, Richard Fairbank, he really framed this as a huge step in their, I think his words were, quest to build a great financial institution.
Yeah, and an integrated banking and global payments platform. That's a pretty grand ambition.
It really is transformative stuff.
And Fairbank mentioned, it's still early days, obviously,
Yeah.
but they're fully mobilized and hard at work on integration.
Which is good to hear because integrating something this size is, well, it's a massive undertaking.
Definitely. He said the early signs look good. And interestingly, he emphasized this shared, deep commitment to customers between Capital One and Discover.
The culture fit, always important.
Exactly. They seem to think that alignment is really key to unlocking all these new opportunities to, grow and create value.
Okay, so that's the big picture, the vision. But let's get back to those Q2 financials, especially that reported loss. This is where, it gets really interesting.
Yeah, the gap versus adjusted reality. It's crucial here.
Right. So on a GAAP basis that's generally accepted, accounting principles Capital One reported that net loss, $4.3 billion, or 8.58 cents per share.
Which is a huge swing from the profit they reported just the quarter
A
before.
massive swing. But then you look at the adjusted number.
Right. After you account for these specific adjusting items, mostly tied to Discover, the adjusted net income was actually a solid $2.8 billion.
Or $5.48 per share. So the obvious question for you listening is, what are these adjusting items that cause such a dramatic difference?
It really boils down to the accounting mechanics of buying a whole company like Discover.
Okay, break it down for us. What's the biggest factor?
By far the biggest was a massive provision expense build, $8.8 billion.
Wow, $8.8 billion? What's that for?
That was for Discover's non-PCD loans. PCD means purchased credit impaired. So these are the acquired loans that weren't already significantly impaired when they bought them.
Okay.
So basically, accounting rules say when you buy a big loan portfolio like Discover's, you have to immediately set aside a big chunk of money up front to cover potential future losses on those loans.
Even if they're performing okay right now.
Exactly. It's a required accounting adjustment, sort of a day one provision for the credit risk they just took on.
Okay, that makes sense why it's so large then. What else was in those adjustments?
Well, there was also a $255 million increase in non-interest expense. This came from amortizing newly recognized intangible assets.
Intangibles. Okay, so things you can't physically touch but are still valuable.
Precisely. Things like the value of Discover's existing credit card customer relationships, their core deposits, and also those important network and financial partner relationships.
And how much are those worth?
Altogether, they value these things at over $12 billion. So the amortization is basically spreading the accounting cost of acquiring that value over time.
Got it. So it hits the expense line even though it's not like cash going out the door each quarter for that specific item.
Right. It represents the ongoing accounting cost of buying Discover's strategic assets beyond just the loans.
Okay. What else? Anything else significant?
There was also an $85 million decrease in net interest income. This was due to amortizing what they call net fair value discounts on Discover's acquired loans and deposits.
Sounds complex.
It's another required accounting adjustment related to bringing Discover's massive balance sheet. We're talking, Nearly $100 billion in card loans, $10 million in personal loans, over $100 billion in deposits onto Capital One's books at fair value.
Okay, so lots of big required accounting moves related to the purchase.
Exactly. Plus, there were some smaller items, about $299 million in Discover integration expenses, like actual costs of combining things, and a small $41 million bump to legal reserves.
And didn't you mention something that helped offset the loss a bit?
Oh, right. Yeah, there was a notable item, a $128 million tax benefit from a change in California's tax rate, which actually reduced the GAAP net loss slightly.
Okay, so that's a whirlwind tour of the adjustments. Thanks for breaking that down. Now, putting that aside, how did the combined company actually perform operationally in the part of the quarter after the deal closed?
Well, the legacy Discover business, just in that partial period from May 18th, contributed about $2 billion in revenue.
That's pretty significant for a partial quarter.
It is, but because of all that purchase accounting we just discussed, it also contributed a $6.4 billion net loss to continuing operations.
Okay, so that's where a lot of the GAAP loss came from. But what about the underlying business trends? Revenue, expenses.
That's where the story gets more positive.
Yeah.
Total net revenue for Capital One overall actually jumped 25% compared to Q1, hitting $12.5 billion, largely thanks to adding Discover.
Okay, a 25% jump is strong.
And adjusted revenue was up 26%. Non-interest expenses also went up about 18% to $7.0 billion. That includes higher marketing spend and operating costs, as you'd expect with adding a whole new company.
Right, costs go up too. But what about profitability before those big loan provisions?
Ah, yes, the pre-provision earnings. That's a really important metric here. It was up a very strong 34% from Q1, reaching $5.5 billion.
Okay, 34% increase in pre-provision earnings. What does that tell you?
It tells you that the core engine of the combined business generating revenue and managing basic operating costs was actually performing really well. That underlying operational strength is there before you factor in those huge, mainly acquisition-related credit provisions.
That's a key insight. And the balance sheet must look pretty different now, too.
Oh, dramatically different. Period-end loans held for investment, they soared 36% to about $439 billion.
Wow, and that's mostly Discover.
Yeah, largely from adding nearly $100 billion in Discover card loans and almost $10 billion in Discover personal loans.
And deposits.
Same story. Total deposits surged 27% to $468 billion with the addition of Discover's deposit base.
Okay, so scale-wise, it's a whole new ballgame. What about margins, like the net interest margin, NI?
That saw a big jump too. NII increased by 69 basis points to 7.62%.
69 basis points is significant. How much of that was Discover?
They said Discover's partial impact contributed about 40 basis points to that increase. And get this, there was an interesting little quirk.
Oh, yeah.
About 6 basis points of that NIM increase came from Capital One, changing Discover's old accounting practice.
Yeah.
They're now including Discover's late fees and interest income, which Discover apparently didn't do historically. Bit of a tailwind there.
Interesting detail. So bigger balance sheet, higher NABs. What about their capital levels? Did taking on Discover strain their capital?
You might think so, but actually no. Their Common Equity Tier 1 or CET1 capital ratio ended the quarter at a very strong 14%.
14%. How does that compare?
It was actually 40 basis points higher than Q1, and they pointed out it's meaningfully above both legacy Capital One's target of around 11% and Discover's old target of 10-11%.
So they absorbed this massive acquisition and still ended up with a stronger capital ratio. That's pretty impressive.
It really is. It suggests they structured the deal carefully from a capital perspective.
Okay, so that's the snapshot of Q2. Looking ahead now, what's the plan for integration and beyond?
Well, they acknowledged that the initial integration costs might end up being somewhat higher than the $2.8 billion they originally forecast.
Uh-oh, cost overruns already.
Maybe slightly higher costs, but they quickly added they are still on track to deliver the $2.5 billion in total net synergies they talked about when the deal was announced.
Okay, so the expected long-term benefits, the synergies, are still on track. That's the main thing.
Right, and that includes both cost savings from combining operations, but also, importantly, real revenue synergies making more money together than they could apart.
And Fairbanks seemed pretty bullish about the future rate.
Extremely bullish. He described this moment as having the broadest and biggest set of opportunities he's seen in the company's history.
High praise. But he also mentioned investment, didn't he?
Yes, he stressed that realizing these opportunities will require significant investment. And it's not just about stitching Discover together with Capital One. There's more to it.
Okay, like what? What are the big investment areas?
Well, a huge one is the Discover network itself. That's a core part of the strategy.
Right, owning their own payment network. That's rare.
Exactly. The plan is to move more of Capital One's own debit card volume and some of their credit card volume eventually onto the Discover network rails.
That makes sense. Why pay fees to Visa or MasterCard if you own a network?
Precisely. But, he cautioned, this is a long game. It requires sustained investment for a number of years.
Investment in what specifically?
Primarily in building out international acceptance for Discover. That means forging partnerships with other networks overseas, with merchant acquirers, other card issuers, maybe even going direct to merchants in some cases.
So, making the Discover card as usable globally as Visa or MasterCard.
That's the goal. And then building Discover into a truly global network brand. He made a powerful point. There are only 2 banks in the world with their own network, and we are one of them.
That really highlights the uniqueness of this asset, doesn't it?
It absolutely does. It's a massive, rare, strategic advantage if they can execute on it.
Are they starting that network transition?
Yes, the debit conversion started with some pilots back in June. They expect to get the majority of customers switched over by the end of 2025 and be fully done by early 2026.
And you mentioned this allows for direct merchant relationships.
Right. Owning the network potentially lets them build more direct connections with merchants, maybe cutting out some middlemen.
Okay, so the Discover network is priority 1. What else?
They also highlighted their own ongoing tech journey. Capital One's been at this for, 13 years now?
13 years, yeah. They're all in technology transformation.
Right, rebuilding everything from the bottom of the tech stack up. They want to be a modern technology company that does banking.
And the idea is that this long-term tech investment makes integrating Discover and pursuing these other opportunities faster and easier.
That seems to be the logic. Their modern tech foundation should accelerate everything else.
They also talked about building their national bank differently, right?
Yeah, that was interesting. Unlike many big banks that grew nationally, mainly by buying other banks, Capital One emphasizes they're building a national full-service bank organically,
How are they doing that?
leveraging that tech stack, their digital banking offerings, their sort of unique, thin, physical distribution model with a cafe-style branches, and their national brand recognition.
And their value proposition helps too, presumably.
Definitely. They push the no fees, no minimums, and no overdraft fees angle hard. They say it's getting a lot of traction.
But that requires marketing investment.
Yes. Sustained investment in marketing. And they actually said they expect to lean in even more on marketing spend to push that national bank growth.
Okay, what else? Any other big strategic pushes?
Well, there's their long-term quest to win at the top of the card market with heavy spenders. They've been focused on this since 2010.
Ah, right, the premium card space. Very
It's
competitive.
extremely. They know it's a long one and requires leaning into this big opportunity because competitors are spending heavily too.
So things like their Venture X card.
Exactly. The 2x earn rate on everything is a key feature. Plus, investments in things like airport lounges and unique access. They mentioned the Taylor Swift partnership as an example.
Trying to create differentiation beyond just points.
Right. And then, of course, there's AI.
Can't have a strategy discussion without AI these days.
Pretty much. Their view is that only companies with a really modern tech stack and deep data capabilities will be able to truly reinvent their business model to put AI at the heart of operations, risk management, and the customer experience.
So they see their tech transformation as a prerequisite for winning with AI.
It seems so. They called AI a transformational opportunity requiring sustained investment in AI and in AI talent. Sounds like a major focus area.
Okay, so network, tech, national bank, premium cards, AI, lots of big investment areas. Does all this spending worry them about future earnings?
It's a fair question.
Yeah.
But they addressed it. They estimate that the ultimate earnings power of our combined company, once the integration is done and these investments mature, should be consistent with what we assumed at the time of our deal announcement.
So they believe the payoff will justify the investment, essentially.
That's the message. They're confident the long-term earnings potential is still there, despite the upfront costs and investments.
And what about managing their capital through all this? That 14% CET1 ratio is strong now, but will they maintain it?
They said they feel comfortable operating with that excess capital for now, above their long-term need. They're still doing the detailed modeling for the combined company's ongoing capital requirements.
But what happens after that modeling is done?
They expect to begin to step up our repurchases from recent levels.
So potentially more share buybacks coming down the road once they have clarity on capital needs. Good news for investors.
Potentially, yes. Something to watch for.
Okay, let's shift gears slightly. What did they say about the broader environment, the U.S. consumer credit trends?
Generally positive. They described the U.S. consumer as still being a source of strength in the economy.
Despite inflation concerns?
Yeah, they acknowledged inflation pressure, but pointed to low unemployment, healthy job creation, real wage growth picking up, and consumer debt burdens being stable, actually near pre-pandemic levels.
So overall, the consumer backdrop looks pretty resilient from their perspective.
That was their take. And it seems to be reflected in their own portfolio's credit trends, too.
Oh, yeah. What are they seeing?
For Capital One's legacy card portfolio, they're seeing improving delinquency rates, lower entries into delinquency, and improving payment rates.
So credit quality is getting better.
Trends are positive, yes. They did mention some lingering effects from pandemic-related forbearance ending, leading to some delayed charge-offs, but the overall direction seems good.
And what about the Discover portfolio they just acquired? How does its credit look?
Discover's credit metrics apparently peaked a bit later than Capital One's did after the pandemic stimulus wore off. But now, Discover's metrics are also improving steadily.
Okay, good. Is the Discover portfolio very different from Capital One's?
There is a difference they highlighted. Discover's portfolio was described as being a little bit more of a revolver-oriented portfolio.
Meaning more customers carry a balance month to month.
Exactly. Compared to Capital One's own portfolio, which they characterized as maybe more spend-driven, with potentially more customers paying off balances for rewards.
So Discover brings a slightly different customer mix, maybe more focused on borrowing.
It seems that way, which could be a good diversifier for Capital One and potentially quite profitable if managed well.
Are they planning changes to Discover's products?
They plan to lean into growth opportunities with Discover. That means continuing things that were working well, like Discover's popular student credit card and their secured card business.
And they also mentioned customer service.
Yeah, they specifically mentioned adopting Discover's traditionally strong customer service experiences, suggesting they see value there too.
Okay, so quite a quarter. Massive acquisition, complex accounting, but a clear, ambitious long-term strategy focused on network, tech, and growth.
Absolutely, a lot to digest.
So as we wrap up this deep dive, maybe a final thought for you, the listener. What really stands out? Consider this. Is Capital One's really bold strategy investing so heavily in organic growth, in that modern tech stack, in building out their own global payments network, leaning into AI, all while integrating this enormous Discover acquisition? Is that the blueprint for the financial institution of the future?
It's a huge bet on that integrated tech-forward model, isn't it?
It really is. And how might this massive move shape not just Capital One's competitive position, but maybe even the way all of us interact with our money in the years ahead? Something to think about.